First time guest, you asked for him. He's here. It's Ron the Mortgage Guy, starting right after the music.
This is Debt Free in 30. Here's your host, Doug Hoyes.
Last week, Ben Rabideau was my guest on the show, and he mentioned that the go-to guy for the inside scoop on what's happening in the mortgage market is Ron Butler. And so, of course, after Ben mentioned that, I got lots of tweets and messages saying to get Ron on. Well, we did. Ron, thanks for taking the time to be here today. Can you start us off with a quick summary of what you do?
We're mortgage brokers. We're a family business, independent mortgage brokers. We originate about $1 billion in mortgages a year, all types of different mortgages, whether it's tons of bank mortgages, low rate discounted mortgages, specialized mortgages, B mortgages. We were even up until recently involved in the private mortgage business. And you name it, we've sort of covered it. And for many years, this is going into my 26th year. So that's who we are.
And so primarily you're dealing with the end customer. Somebody is buying a house, doing a refinancing, they call you.
Precisely correct.
Excellent. Okay, so I've got two questions for you today. What's going on and what's your advice? That they're probably going to be a little more detailed than that, but that's really what I'm wanting to know. What's going on? So let's start with what you think is happening in the real estate market, because if there's nothing happening in the real estate market, then I guess there's nothing happening in the mortgage market. So we are recording this. It is Wednesday, April the 8th that we're recording this. What do you think is going to happen in the real estate market? Let's take the GTA, the Greater Toronto Area, for the month of April.
Well, I suspect that based on some informal discussions I've had with other mortgage brokers, analyzing the volume of purchase mortgage applications we've been receiving in the last 2 weeks, which is and we're pretty busy mortgage brokers. And I was talking to busy mortgage brokers, and their response is basically, what purchase mortgage business? Like, there isn't any purchase mortgage business. So my suspicion is that when the month-end figures come out at the end of April, that we'll see purchase activity in the GTA, Greater Hamilton area, the Southwestern Ontario. We'll see purchase activity drop between 80 and 90%.
Which is pretty much everything dropping then, is what that tells me. So why is that? Is it because I can't have an open house because of the virus? Is it some other factor? What's causing that?
Well, I think there's a couple of factors, but obviously the COVID is the major question. I mean, I don't know why anyone would want a stranger to come into their house, and I don't know why you would want to go into a stranger's house. And even though it's certainly possible to sell a standardized condo virtually, I mean, they're basically a concrete shoebox. You analyze the square footage, you're about done. But I can't imagine any single family home or townhouse being sold sight unseen, like just the video. And based on what we're hearing, nobody is. The second factor is a lack of confidence in what's going on to move your future forward. If you're planning on making a major decision right now, committing to a new home, committing to an upgraded home, committing to the purchase of a rental property, you've got to be stopping yourself and thinking, well, maybe I should just wait. Maybe I should just sit back, take 3 or 4 months and see what the end result of all this is. I think those two factors combined equals negligible purchase activity, likely for the next 2 months.
Yeah, it makes sense, because if with what's going on, I can't imagine real estate prices going up tomorrow. So it's more likely they go down. And Ben and I talked about this last week with, all the Airbnb inventory potentially coming on the market, a bunch of things like that. So yeah, I might as well wait because the price will be cheaper in the future potentially. So let's assume that you're correct, and there's very low activity in April. Let's say there's very low activity in May as well. And let's say maybe by June, things are starting to unfreeze, get back to some semblance of normal. So does that mean then in June, there will be 3 times as many transactions as there would have otherwise been because all the excess supply just happens to come to the fruition in June?
I would suggest the possibility of that is roughly the same as the meteorite hitting the earth right now and wiping the species out. I mean, it just doesn't make sense. It doesn't make sense that a 100-year worldwide catastrophe would emerge, we would emerge from that vortex, and that every single person who ever wanted to buy a house on a delayed basis would rush out in June and buy the houses. It's just not even, it's not even logistically feasible, to be honest with you. So what I would tell you is that and I think this is the difference between people like you and I who talk to ordinary people every day about their issues and policymakers who only talk to other policymakers. That they don't understand that there is going to be a gap. That this is not just turning an economy off and then turning it back on again. First of all, it's really easy to turn an economy off. You just say, everybody, you have to shut now. And it's the law. So you can turn an economy off really easily. But it beats the hell out of me how you ramp up an economy. You just don't announce, well, you can all go back to work now. And the employer says, well, wait a second, I don't want everybody back to work. It doesn't even make sense. You know, we laid off 10,000 casino workers in one day in this province. But 10,000 people were told not to come in anymore. So when the casinos open, again, don't get me wrong, I like a casino. I'm not anti-casino, but the chances are that day every single casino worker will be recalled to work is like literally preposterous. It doesn't make sense. They're going to observe their business, as is every chain restaurant, as is every store. They're going to say, we're going to bring a minimal amount of people back and we're going to see what the volume is like. And that is no doubt what's going to happen. I mean, nothing else makes sense. So what we end up with is a gap of time where people did not make the money that they were expecting to make, that they did not have the economic opportunities they expected to have. And activity died for this period of time. The economy is shut. And it's not like you can just replace it. It's not like when the all clear sounds that every single Canadian who likes a vacation is going to book a trip to Cuba with Air Canada. I mean, it's not just going to happen instantaneously. And this big gap of economic activity is going to be felt for months, if not years. And certainly that is what I don't think policymakers completely understand.
Yeah, your view is the same as mine, that it's not going to be flipping a switch where everybody is back to work instantly. It'll be more like a dimmer switch where, okay, maybe it's the month of June. We're going to gradually bring some people back. Maybe you've got to be a young person. You can't have any underlying, medical issues. You know, the restaurant may not open, but maybe the factory opens for a bit. And so then it gradually comes back. And you're right. That means that people do not have massive amounts of money, and therefore they're not going to be, doing massive real estate purchases. So that all makes sense to me. Now let's talk about everybody's favorite topic, which is HELOCs, home equity lines of credit. And just before we started recording, Ben had actually retweeted something that someone else had said about one of the big banks shutting down the ability to get a HELOC for a rental property. And this is something that you said, well, this didn't happen today. This has been going on for a week or two. And specifically, it was me borrowing against one property so that I can then purchase another rental property. Is that what the specific issue is?
Well, to get really specific, what certain banks have said is that we only wish to see down payment, 20% down payment for rental properties, because you can't, 20 is the minimum, that we don't want to see any borrowed funds, whether it's your HELOC, whether you refinance your house. Gifts are already not acceptable. So you can't get money from your father to buy a rental property. So we want to see only completely unencumbered cash, liquid assets are the only thing we will accept as down payment for the 20% that is required as a minimum. You must have the money, and we will track back every deposit that you've received until we're happy with the idea that it is all your own money.
So if I cashed in an investment for the down payment, that's fine. That was my money. That's cool.
That's fine. That's converting one type of cash into another, one type of liquid asset into cash. That's fine. Okay?
But if my father says, here you go, here's a couple of $100,000 so you can buy the condo, and I go to the bank and say, yeah, I've got the 200,000. Where'd you get it from? Oh, I got it from my father. No, they're not giving me they're not giving me the mortgage on a rental property.
Correct, because you can't use gifted down payment on a rental anyway. Simple as that.
And if my father says, I'll give you the money and put it in as a second mortgage behind the bank, is that good enough?
Absolutely unacceptable. There can't be any sign that it's not totally liquid assets. You either cashed in an RSP, cashed in an investment, you had the cash in your savings account. It has to be your own unencumbered funds. No gifts, no loans, no second mortgages, no HELOC, no nothing. It has to be money.
Okay, that sounds pretty unequivocal. So let's say I'm the banker and I'm deciding I'm going to close my eyes here because I've got to, do my loans. I got to, meet my criteria, my goals for this month. Why would I not just ignore it? Because what do I care? Once the loan is done, well, I've still got security over the property. Why would a banker care about those rules?
Because a banker wants to understand the risk factor in rental purchase and people owning rentals. So you imagine that you're the chief risk officer of a bank and you're getting reports that your ground game people, the people answering the phones for mortgage deferral, are deferring 4 different mortgages on 4 different properties in the first week. So there's an owner-occupied home that the people are out of work and they want a deferral. There's 3 rentals. They want deferrals on all 4 mortgages. So if you're a chief risk officer at a bank, you say to yourself, that's interesting to me. So these people who have owned 3 rental properties cannot make any form of payment to us on the mortgages after they've stopped receiving their income for 2 weeks. That was not the chief risk officer's picture of who these people buying 3 or 4 rental properties were. His picture in his mind was that these are people who have some assets. They have some ability to handle the mortgage payment if their tenants don't pay, if one of them loses their job for a while. In the normal world, not even the COVID world, but the normal world, that these people should never have a problem for 3 or 4 months making these payments. Because if you own 3 rental properties, you shouldn't be on the very economic margins of society that when one single pay bounces that you're in trouble. That doesn't make any sense to a chief risk officer. So that's why there's going to be such close scrutiny of rental purchases moving forward.
And again, let's be clear, we're talking about rental purchases. If I'm going to be buying my first house and my father is going to give me the money for the down payment,
that's allowed.
That's okay.
Allowed. That continues to be allowed.
Okay, that's fine because it's an owner-occupied house. Now,
Correct.
You mentioned the word deferral. So we all understand what that is because the banks have been they've issued press releases saying, oh, if you're having trouble, give us a call. We can defer up to 6 months. So first of all, my understanding is we're talking about my owner-occupied house, not my fleet of rental properties. And you can correct me if I'm wrong on that. But my question...
Well, we absolutely factually know that there's been deferrals given on investment properties.
Okay. And obviously on owner-occupied properties as well.
Correct. Of course,
so
yes.
Is the bank addressing everything on a case-by-case basis, or what are they doing in general?
The policy is different everywhere. But right now, with the encouragement of the federal government and the initial stages of this, the banks, the big 6 banks have pretty well just said, if you apply, we're giving you a deferral.
And what kind of deferral are they giving you? Because the people I've talked to, again, on the ground, they're saying, well, I called the bank and they said, yeah, no problem. We will give you a deferral for this month. Let's talk again next month and see where we're at. Is that the typical thing you're hearing?
We've seen as far out as 3 full months agreed to. But yes, what you describe is more correct. We're going to give you 1 month or 2 months. We're going to revisit this. You're going to get back to us on it.
And just so we're clear, a deferral does not mean you don't have to pay the interest. It just means we're taking the payment and tacking it on to the end?
That's correct. What's going on with a deferral is that you are simply not making a payment, but whatever interest was owed during that period is being tacked on to the end of the mortgage. Like a portion of every payment you make on a mortgage is repayment of principal in any event. So basically, you're just not reducing your mortgage. Let's imagine you've got a $2,000 payment. You're fortunate enough to have a low mortgage rate. 900 of it is principal payment, and 1,100 of it is interest. The interest is being tacked on to the end of the mortgage, and the principal, you're just not reducing the principal anyway. It was basically you paying down your mortgage, you increasing the equity in your home. So definitely what's happening today that's unusual is mortgages under deferral are getting bigger, not smaller. Now, some banks have taken the approach that they also want to later alter your payment system so that you will be catching up in terms of the deferred interest instead of waiting right till the end, waiting till the maturity date and the renewal, that they're going to make an arrangement for you to increase your payment and start catching up the lost interest immediately. But that's a bank by bank decision.
Yeah, and that doesn't surprise me either. So if I go 3 months without making a principal payment, then in order to finish the mortgage, well, I guess I've got to pay for 3 more months, give or take, depending on interest and everything. We're seeing the exact same thing in consumer proposals where someone's in a consumer proposal, they've lost their job, they need a break. So we're going back to the original creditors and saying, hey, can you give us a deferral 3 months, 4 months, 5 months? And they're saying, well, yeah, okay, we're willing to do that. But what we want you to then do is catch up on those missed payments. Because with a consumer proposal, it's a maximum period, 5 years, can't add anything to the end. So if you were paying $300 a month, well, we'll give you the deferral. But then when you come back 5 months from now, we want the payments to be $350 a month to catch up. You're saying something similar to that is happening in some mortgages with some financial institutions.
That is the plan, yes.
I got you. Okay,
Again,
now.
The one thing that the government was very, and let's face it, these banks are cooperating with the government on these issues. The government supplied an unusual amount of liquidity to the bank to all the banks in order to make sure that they would have plenty of money to handle the deferral program. And in response, as the quid pro quo is, not to steal from Trump and impeachment, but the quid pro quo is that you will be very reasonable in offering these services on deferral to your clients. That we want the Canadian public to feel comfortable in that they will not have to worry about their mortgage payments.
Gotcha.
Until this is over. Then there's a whole different set of worries begins. So.
Oh yeah, and that'll be the topic in 4 months when we have you back on. Now, you sent out a bunch of tweets, the title of which was "The New World of Mortgage Lending," and I think this was around April 2nd that you sent this out, so roughly a week ago.
Right.
It began today. Can you summarize what you were saying in that tweet thread, if you can remember that particular tweet thread?
Sure. There's an important date in the mortgage business. That date is March 25th. So if you had purchased a home and received a mortgage commitment, signed that mortgage back, and all of the contracts were in place, so the purchase agreement was going through, your mortgage has been approved prior to March 25th, the word from the government and the banks is that they will make every effort to see that purchase closes, that the financing will not be interrupted by COVID layoff, by industry-related problems, by any rational means. Now, it doesn't mean that if you got in a fist fight with your boss in, April and you're fired for life, that they're going to look at that a little bit askance. But if it's clear that you're laid off due to the contraction of the economy due to COVID, that all these things being in place for your home purchase prior to the 25th, that every effort will be made to allow you to close. So if both of you are laid off, we're still going to try to find a way to get this mortgage closed and get this purchase complete. After the 25th, if you decided to go out and buy a house after the 25th, it's all on you. So no matter what goes wrong between now and then that's preventing you from closing that purchase, or the mortgage has to be refused because you're not a suitable candidate for the mortgage anymore, that's on you. I mean, if you went out and got on that weekend of, I guess, or even last weekend on the 4th, if you bought a house on the 4th and you're now applying for a mortgage, the bank might say, you know what? I know you're not laid off, but you are in the restaurant supply business. So where our choice is, we think we're just going to sit back and wait and see what happens to your industry for a while. We're not going to approve this. Your application is denied. Now that's maybe a very specific situation, and it might not be true if you're making 50% down payment. I mean, every deal is looked at, every mortgage is looked at on an individual basis. But believe me, every email we get about a mortgage application today is describe the occupation in more detail so that we can understand if they will be affected by the current economic problems. Now, I've been doing this 26 years. I've never got those emails before in my life. So it's clear that there is a general concern that the quality of the mortgage borrower will be much, much more carefully vetted than in the past.
And this is something you've seen just in the last couple of weeks, that you can't just put down laborer as your occupation. And if you do, the lender is pushing back saying, we want more details.
Yeah, you can't even get a mortgage approved until you've provided every stitch of income documents up front, and you better have a paycheck that was issued in a pay stub that was issued in the last 2 weeks.
And was it the same 2 years ago, 5 years ago with that?
Not at all. I mean, at the end of the day, if you said you were an electrician and this was your income last year, that's what we submitted. Of course, we have to prove the income, absolutely, in subsequent weeks and maybe months for purchase. We have to provide a plethora of documents. But today, it's about send us all the documents, let us look carefully at this person's income, and we'll decide if we think it's viable in the future.
So this is an actual change that we're seeing. So, okay, my second question then is practical advice. So I am a person and I want to buy a house, not a rental property. I just, want to buy a house, a condo, whatever it is. And I'm looking at the real estate market and going, boy, I agree with you. I think everything's kind of frozen now. There's not going to be a whole lot of transactions. I think that probably means prices are going to go down. So I'm thinking this summer is the perfect time to buy a condo, a house, whatever. So I do not have $1 million cash in the bank. I've got my 20% down payment though, and I want to get a mortgage. So what do I need to know about that? What's different than in the past? What should I be aware of? Or should I just assume, no, I'll have no problem, I'll be able to get it?
I think if you're a permanent public sector employee making an adequate income to justify that mortgage payment, that you don't have too much to worry about. Like, I don't think, two teachers who are partners buying a house together are going to have too much trouble getting a mortgage at all. I mean, they're, tenured teachers, so not going to be an issue. I think that the continued thoughtfulness about what occupations are what, for instance, I hate to say this about my people I know in real estate, but because there's a lot of great realtors, but at the end of the day, there's going to be a lot of thought given to people who are on a pure commission income. Is their income going to be the same this year than it was over the previous 2 years? Or is it going to be the same in 2020 as it was in 2019 and 2018? Because typically for commission people, we use averages. We use 2-year averages. Okay. So you might have had 2 great years, but based on your occupation, the bank is not thinking you're going to have such a great year this year.
And so
now again, other factors, you put 50% down, you get a cosigner, whatever the case may be. I am not suggesting mortgages are going to stop happening. That's absolutely not the case. I'm just talking about a much higher level of scrutiny, And I'm also suggesting to you that if you're going to be buying a house this summer, hopefully have a quick closing, because the real stark unknown about where prices are going to be, if you have a 90 or 120 day closing and you're closing in the fall after you bought in the summer, I mean, there's a potentiality that they'll appraise the house at a lower rate, at a lower value, if values are indeed falling, and you've got another issue to contend with.
Okay, you're going to have to explain how this works then. So I call you up and I say, hey, Ron, I need a mortgage. You say, no problem. We need a whole bunch of paperwork. I send you all the paperwork, pay stubs, everything. And so, but I'm making an offer on this house, but I'm making it conditional on financing.
Correct.
Okay. We've been doing that for 100 years. That's no big deal. So the vendor says, I want to have a closing date of September 30th. And, today is June the 1st. Am I able to lock in the mortgage commitment that far in advance, or can the bank change their mind later?
You're able to lock in the rate, but a condition of every single, conventional mortgage, not the government insured mortgages, but the condition of every single conventional mortgage is that we're going to assess the property valuation in some way, and we are only going to lend to the lesser of the purchase price or the property valuation. That's where we're going to lend to. So my fear is that people buying in June and closing in September might find that there's some degree of value erosion. So if the closing on September 30th, if you do an appraisal on the 10th of September, that indeed the house might be considered by the appraiser to be worth a little less, and you're going to have to come up with the difference as down payment.
Wow. So having a pre-approved mortgage means I've been pre-approved for the rate. Yes,
Correct.
we're going to lock in the,
Correct.
3% or whatever it is. And I'm being pre-approved for a percentage of the value of the house. So they're going to lend me 80% of what the value of the house is. So if the value is $1 million and that's what I've paid for it, great. They'll give me my $800,000 mortgage. But 3 weeks before closing, I could find out that the house is only worth $900,000. So now I can't get an $800,000 mortgage. It's obviously some number less than that. And you're saying that could definitely happen.
Well, it's happened before. You might recall that there was a great run up in real estate prices in the GTA, and then there was a fall off. If we look back on 2018, prices came off from a super aggressive run up of, in some cases, 30% in 1 year. So if you'd bought a new construction home in the very heat of the run up and then didn't close for a year, the appraiser would come by and say, you know what? There's reselling in the previous phase. They're selling properties in the previous phase to this phase for less than what you paid. So, we can't justify saying that somehow your value is still the purchase price. There has been, John, Salas, and Steve, they wrote a bunch of information about value declines both in Vancouver and in the GTA, particularly in the York region. And if that applied to a new construction home, there's no escape from it. I mean, you simply pay too much because there was a disruption in market values. And yes, we saw those situations where people had to get more money to provide additional down payment.
And you're not talking about 1950. You're talking about 2-3 years ago. This is not.
I'm talking about 2 years ago, yes.
Yeah, this is not ancient history. So I'm 3 weeks in advance of closing, and I could be in a situation where I got to come up with 50 grand more than what I thought I was going to have to come up with.
It's possible. Like I'm not one of the people who's absolutely giving rock solid predictions on the value of properties in the GTA post-COVID. I feel that there has got to be a general belief that there'll be a bit less desire to buy based on some of the things we've already talked about, a bit less ability to buy based on some of the things we've talked about, a bit of pressure on rentals, such as we've all read about the Airbnbs going on the market, because guess what? It was always a kind of an illegal hotel and everybody stopped coming. So we've had 4 months of no rent, no income in my Airbnb, nothing. And I think I would rather sell than find a long-term renter. So there's that inventory that will eventually come on the market. Look, I'm not suggesting, I'm not enough of a soothsayer to tell you that I know property values are going to go down in the GTA or give a number, but I'll tell you what, I worry about it a bit. So I have to inject that note of caution into something we've already seen already. We saw it 2 years ago. People had to come up with more down payment because the appraisal did not work out.
Yeah, well, and the way the internet works, I'll take a clip of you saying the real estate market is going to crash and it will go all over the place, and everyone will be, sending you all sorts of tweets and everything saying, "Oh, this is what he said," and everything will get taken out of context. But I appreciate the comment you've made, which is on the balance of probabilities. If people aren't buying houses, if all the Airbnb inventory comes on, if people aren't working, then prices likely will go down, and there is a significant risk to you as a purchaser, particularly with a long closing, that you may end up having to come up with some more cash. So either have some cash in the bank or have a short closing so that hopefully there isn't that big erosion of value during that time period.
That in a time of considerable uncertainty, and I don't know how the hell you describe this as anything but uncertain, I think you need to exercise a lot of caution and have reserves set aside to handle any contingency.
Excellent. Well, I think that's a great way to end it. Are there any final points, practical advice, anything that is sticking in your brain that we definitely should have talked about today?
I think for people who are worried about their situation in terms of, hey, I've got a lot of equity in this house, maybe I should refinance it and tidy up all my debts and maybe take some extra cash out in case I've been laid off. Because let's face it, if you've been laid off, it's not the right time to refinance. The only people who are going to give you a loan are at very, very high rates, and I don't think that's always in your best interest. I've also put that out in social media that I don't think it's necessary. You got to be so cautious before you take a high interest rate private loan, private mortgage, and if you're worried about your situation, because as we noticed, the various government programs kept escalating as time went by. And for people who took out a private mortgage when there was no $1,800, $2,000 a month program, they maybe did something they shouldn't have done. I highly urge that people exercise caution in that regard. And for people who could qualify for refinance, if it's really makes sense to you, do it. But in times like these, I sincerely believe that just pushing the pause button might be a better solution than running out and making instant decisions.
Yeah.
So that's sort of my last word on the idea of refinancing and increasing your mortgage in a potentially dangerous moment.
Yeah, and I'm not a big fan of increasing debt at any time, so I would agree with you there. So if I already have a HELOC on my house and it's got another couple of $100,000 of borrowing room available, do you think it's like, well, maybe I should at least pull 50 or 100 grand out of it? Because as Ben was alluding to last week on the show, maybe the banks will be lowering available credit limits. Maybe that $200,000 HELOC that you've got, you won't have in the future. Do you think that's something that if I think I might need the money in the next 6 months, I should draw on it now?
I think Ben is not wrong, but there's some qualifiers, which even Ben alluded to afterwards. If you're a physician making $500,000 a year and you've got a $300,000 HELOC, I don't think the bank's going to touch it. I think you're just fine. I think that certainly for any individual where they are missing payments on anything, whether it's even a credit card, no matter even if they're perfect payers on their HELOC, if it's with the same institution, the institution may consider making changes to your limit on your HELOC. I think that if the same institution comes to realize that you're no longer receiving your normal paycheck anymore and you're receiving the COVID benefit, that they may think about, well, should this person really have a $300,000 available HELOC? I'm not pretending to be a banker. I'm not pretending to make that I know banks' internal policy decisions. I don't. But I do believe that every rational banker will think hard about people who are making much less money now, but they have access to $300,000 of borrowing. I think any rational banker gives that some thought. Again, it's a client by client, bank by bank decision, but I know what I'd think. I absolutely know what I'd think if I was presented with some of those circumstances.
Yeah, well, we're in a new world, and I think you've given some very practical advice. If you've got a house closing in the future, well, be careful. If there's a HELOC sitting there that you think you can rely on, well, be careful. Maybe nothing will change, maybe it will, but now is not the time to be taking on any additional risk, that's for sure. So, Ron, thank you very much. People can find you on Twitter at Ron Mortgage Guy. And you're never shy about sharing your opinions. So I think that's certainly a good place for people to find you. Your company website is butlermortgage.ca, and I'll put a link to that in the show notes as well on YouTube. At Ron Mortgage Guy, butlermortgage.ca. Ron, thanks very much for being here today.
My pleasure, Doug. Thank you.
Thank you. That was our show for today. As I said, I'll put links to Ron's Twitter account and website in the show notes over on YouTube on our Debt Free in 30 channel. Thanks for listening. Until next week, I'm Doug Hoyes. That was Debt Free in 30.